Oil prices momentarily fell to levels once seen before during December of 2021, early this week after a controversial Wall Street Journal reported pointing out that OPEC Plus may partially reduce its output supply cuts to counteract the deficit to be created by the G7's looming pressure cap on Russian crude. Not only that, but the rollover of stricter COVID lockdowns in China's cases reignite dismounted hopes for increased oil demand from the oil-consuming giant and stock fears for a severe global economic downturn. In this report, we aim to shed light on the catalyst driving WTI's price, assess its future outlook, and conclude with a technical analysis. Reopening optimism quickly evaporated this week as COVID infection cases continued to emerge across major Chinese cities. More specifically, capitals of major provinces such as Guangzhou and Sichuan, alongside Beijing, implement tighter restrictions in an attempt to squash rising cases. Moreover, the city of Zhengzhou is also set to enforce an effective lockdown for its 6 million residents this Friday, officials announced. Without a doubt, ongoing lockdowns paint a bleak picture of the demand side of oil for the second largest economy of the world. Furthermore, yesterday, Wednesday, Chinese authorities announced more than 31,000 new COVID cases, the highest since the peak month of April, and according to reports, the authorities remain too resolute at stamping out the nationwide outbreaks. As a consequence, the latest developments have pushed commodity traders to reassess and revise any bets for any short-term price hike in oil prices. All things considered, the prolonged extension of draconian measures could keep oil prices suppressed as Chinese authorities continue to implement their zero-COVID policy agenda, darkening the country's economic outlook. Earlier this week, a report from Wall Street Journal surfaced stating that according to OPEC Plus representatives, the oil cartel plans to increase its output in an attempt to counteract the European Union's embargo on Russian oil. Crude oil prices fell sharply as the news implied that the Saudi-led group is going back on its word, reversing partially in a way the earlier announcement of cutting supply output by 2 million barrels per day. The fall did not last long enough, however, since Prince Abdulaziz bin Salman, the energy minister of Saudi Arabia, explicitly stated, as reported by Financial Times, that the current cut of 2 million barrels per day by OPEC Plus continues until the end of 2023, and if there is a need to take further measures by reducing production to balance supply and demand, we always remain ready to intervene, unconditionally dismissing the rumors. As a result, oil prices quickly regained the lost ground, bouncing back up to their previous trading range. In hindsight, the narrative proposed by the Wall Street Journal appeared highly unlikely to materialize, since we have heard numerous times in the past the cartel's concerns in regards to the divergence of crude prices and underlying fundamentals, as well as the outright warnings for potential intervention should the price fall lower than the organization's projections. The market nonetheless displayed once again that it's quick on its feet to assess new incoming information, adjusting course accordingly, and the whipsaw observed testifies to that. Nonetheless, and moving past the volatile event, oil prices continue to be negatively predisposed for further downside as we approach closer to the EU's price cap deadline in early December. Thank you for watching.